Working in California as a travel nurse is honestly one of the best investments that I could have made. I've been able to save over $4,300 per month for investments. Putting away $3,300 monthly has set me up to be able to buy my first house whenever the right deal comes around. I've been able to max out my Roth IRA with a $500 monthly contribution, as well as invest an extra $500 in whatever asset class of my choosing. Anyways, today I'm going to talk about how I make a passive income of $100 per month from dividends and why I think this is the best way to invest outside of a retirement fund for nurses. Now, I'm a really big fan of owning assets that produce passive income, and if you're wondering how to increase your passive income streams, then dividend investing could be a great way to do that. Okay, before we get into why dividend investing is my favorite way for nurses to invest, I'll briefly explain why companies pay dividends, some things to watch out for, dividend investing basics, and some companies that pay me $100 per month in dividends. So really quickly, let's go over what a dividend is. So a dividend is a payment that a company makes to share its profits with shareholders. They're paid out on a regular basis and are incentive for investors as they allow them to earn a return from investing in stock. Now, dividends are paid out to you per share of stock that you own. So let's say that you own 10 shares of Company A. If Company A pays you $5 in dividends annually per share, you'll make $50 that year. Now, there are different ways that you can get paid a dividend. The most common way is a cash dividend, and the company will directly deposit cash into your brokerage account. Companies may also opt to issue stock dividends, so instead of paying cash, they will pay you with additional shares of stock. Another form of dividend are dividend reinvestment programs, or DRIPs, and this allows you to reinvest any dividends received back into more shares of a company's stock for discount. We can also see preferred dividends, which are payouts given to owners of preferred stock. Now, preferred stock functions more like a bond, and these dividends are usually paid quarterly and are most often fixed. The last form of a dividend is a special dividend, and these are just like a cash dividend. The only difference is that sometimes companies will issue special dividends to distribute accumulated profits that they don't have an immediate need for. Now, before we get into my top dividend stock picks, I want to caution you against just chasing the highest dividend stocks. Although a high dividend may indicate that a company is profitable and is simply redistributing extra income, it could also indicate a business in distress. A high yield may still be in place even if a company has struggled financially and simply has not cut its dividend yet. You need to pay really close attention to the dividend history to see if a company has been consistently paying those dividends. Also, make sure to take a look at the company's free cash flow, as this can be an indicator on whether or not they're able to make these dividend payments on a consistent basis. Now, there are a few really important things to consider before purchasing a dividend stock. The first is the ex-dividend date, and this is that on which the dividend eligibility expires. So let's say that the ex-dividend date for a certain stock is September 1st. If you buy the stock on or after that day, you will not receive a dividend. However, for those that buy the stock prior to that date, they will receive the dividend. Now, when you're assessing a dividend stock, it's important to take a look at the numbers of the company. I've gone in depth on this in my beginner investor's guide, which I'll link above. I highly recommend it, especially if you are new to investing, as this is a short 30-minute guide that will give you everything you need to start investing in the stock market. In that guide, I talk about how to assess a company to determine if it's a good investment, so I definitely recommend checking that one out. But for dividend stocks in particular, you also want to compare stocks based on their dividend payment performance. To do this, you can use the dividend yield factor, which measures the dividend as a percentage of the current market price per share. The dividend rate can also be quoted as dividends per share, or DPS, which is the dollar amount that you'll receive. Another important metric to look for is the return factor, which accounts for dividends, increases in share price, and other capital gains. So why is dividend investing one of my favorite ways for nurses in particular to invest? Simply put, this method of investing is one of the most passive and stable ways to earn income from the stock market. I invest heavily in dividend stocks to 1, outpace inflation, and 2, earn passive income. With dividends, you not only are invested in stock that has the potential to appreciate over time, but you're also collecting regular returns on your investment. Taxes can also be a factor in dividend investing. Investors in higher tax brackets are often observed to prefer dividend-paying stocks if their respective area allows for lower or even zero tax on dividends. Here in the US, dividends are taxed at lower rates than ordinary income. Those in the 35 or 37% tax brackets are only taxed 20% on their dividends. If you earn an average nursing salary, your income tax rate is probably between 12 and 35%, and you would only be taxed at 15%. And then for those in the 10 and 12% brackets, you won't pay tax on qualified dividends. So for any of you students watching, this is your cue. Alright, so hopefully by this point in the video, I've convinced you how dividend stocks are one of the best assets that provide passive income, and here is where I show you some of my top dividend stocks to look at buying right now. As a disclaimer, I'm investing in several of these companies and this is by no means financial advice. These are simply stocks that I believe in and that I am backing with my money and my research. I'll present you with some of my own research on these names, but that doesn't honestly replace doing your own due diligence on these. Anyways, my first stock is Kraft Heinz. You've probably heard of them before because they make all of your condiments such as mustard and ketchup and mayo. This is a consumer staple stock, and for those who have been following me for a while now, you know how much of a nut I am for studying market cycles, and in high inflationary periods like we're in right now, consumer staple stocks do really well. They had a total revenue of $26 billion last year and have a strong annual dividend of 4%, which comes out to $1.60 per share. The current price for a share of Kraft Heinz is around $39, so a $2,400 investment would net you around $100 in yearly passive income. The price of the stock has stayed relatively flat with a moderate increase in price, which is pretty decent compared to the S&P 500, which is down over 9% over the last year. Now I'm keeping a close eye on this dividend because in 2019 they dropped their dividend payout, although it has been holding steady ever since. I'm not really worried about their financials, and the fact that their products are already in demand, regardless of the market environment, gives me a reason not to doubt their outlook. However, if the dividend decreases or fails to increase in the next few quarters, I'll probably look to reallocate my funds towards something more promising. My next stock is Philip Morris, or stock ticker PM. This is a tobacco company and is categorized as a SIN stock. Now, for those of you who aren't familiar with a SIN stock, these are shares in a company involved in activities that are considered unethical, such as gambling, adult entertainment, alcohol, and tobacco. So obviously, if ethics do play a role in your investment decision making, by all means, please feel free to skip this recommendation and move to the next. But regardless, I feel like this undervalued stock has a lot of good things going for it, which could not only give you solid returns on your money over the years, but could also contribute to steadily rising dividends. I mean, we've seen Philip Morris's compounded annual growth rate between 3 and 5%. Now, I know that investing in tobacco companies can sometimes seem like swimming upstream, especially as attention is drawn to tech companies away from dirty stocks. And although the number of smokers is declining, smoking is very highly addictive and prices won't go down because of that. I mean, look at their free cash. We went from $8 billion in free cash in 2018 to $11.2 billion in 2021. Oh, and for those of you who don't know how I calculate free cash, just go to their cash flow statement and subtract capital expenditure from operating cash flow. This will give you the amount of free cash that is available to be reinvested back into the company. Speaking of free cash, remember how in the beginning of this video we discussed how companies with excessive cash lying around will oftentimes create dividends that will pay their investors back? Well, Philip Morris has a solid dividend yield of 5.05% and an annual dividend of $5.08. That means that for every share that you own of Philip Morris, you'll be receiving $5 per year in cash. For a stock that has growing amounts of free cash every year, that gives you as the investor confidence that this dividend won't go away. In fact, if we look at the dividend history, we can see that their quarterly payouts every year going from 85 cents in 2013 to $1.14 in 2017 to $1.27 in 2022. Point being, this is a solid company with high earnings growth, increases in free cash every year, and a growing dividend. Now, I don't know about you, but I'd rather have my money in a potentially undervalued company whose dividend alone will help me outpace inflation, not to mention that this company also has potential for massive growth over the years. Honestly, I'm buying shares of this company and holding for at least a decade. This is just one of these companies that is such a solid and low maintenance pick. I just check their numbers quarterly, make sure that their dividends are still rising, and besides that, I'm just letting that money sit to make more money for me. Lastly, I want to give you guys an ETF, which is a compilation of many different companies which helps you manage your risk. This last stock is Nationwide NASDAQ 100 Risk Managed Income ETF, or stock ticker NUSI. NUSI not only invests in stocks included in the NASDAQ 100 index, but they also buy covered calls on the NASDAQ stock that it owns while also buying puts on the NASDAQ 100, which aids in risk management. I really love this strategy and it's very unique because we have seen a lot of market volatility recently, and this looks to be a great way to hedge against that. NUSI has an attractive annual dividend of 8.83%, or $1.67, and the great thing about this ETF is that they pay out their dividends monthly. Now, just like with all mutual funds, NUSI has an expense ratio which helps to cover the fund's operating expenses. This expense ratio is 0.68%, which is a little bit above average, but overall is a pretty insignificant number. Now, I highly recommend diversifying your portfolio with various companies that have different levels of risk. One of my favorite strategies is to invest in a dividend-focused exchange-traded fund, or ETF. This would allow you to have a diversified portfolio of dividend stocks that generate passive income. Focusing on quality companies with a strong history of dividend growth is much safer than buying high dividend yield stocks that may be more risky. As a nurse, I know you can be busy with life and probably the last thing you want to be thinking about is investing, but dividends give you a great way to get exposure to the stock market while being a passive income stream. Hey, if you like this video, please be sure to smash that like button. Also, if you want to follow me on my journey to becoming a millionaire nurse, make sure to subscribe to my channel. Anyways, I look forward to seeing you on the next video. Peace.